And the foundation of the thesis for precious metals is there. I mean, we've got production of gold declining across most of the majors, which marked the beginning of a secular market in the 70s and the early 2000s. We have central banks accumulating the metal. We have a trifecta of macro imbalances with the debt problem of the 40s, the inflation of the 70s, and the valuation problem of the late 90s. Gold, to me, is poised for a major breakout, and that will mark the beginning of a cycle, in my view.
This is Kaiser Johnson with Liberty in Finance, and this is our weekly special for November 20th through November 27th, 2023, while supplies last. First this week, we feature 1/10 ounce gold eagles at just $32 over melt. Next, the Royal Canadian Mint's half-ounce silver polar bears are available at just $2.35 over melt per coin. Both our specials this week are IRA eligible. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend Tavi Costa from Crescat Capital. Tavi, thank you so much for joining us today.
Thanks for having me. Looking forward to this.
Well, it's great to have you. I did want to discuss with you the recent price action in the metals markets, and I know that you are very bullish on precious metals right now. What do you make of kind of, I guess, if you look at the last few months, pretty sideways action, even though we've seen a lot of developments geopolitically that would be bullish for gold. Your take on where we are right now?
It's almost very telegraphed what's happening currently with the precious metal space, with gold about to break out from a triple top, and you have the miners still trading at very depressed valuations. In my view, we're going to see another beginning of a secular market for the metals overall, and I've never seen one where silver doesn't lead the way to the upside. And so I believe strongly we're going to see that, and likely a massive re-rating of valuations across most of the miners, which have been, I would say, in one of the most skepticism across the industry, and also in line with the fact that we've had this CapEx trend being so suppressed over the years, given the conservatism across most of those management teams, given the lack of access for capital among most producers overall. We're seeing most of the miners, the large ones, starting to engage with the smaller companies. We're starting to see some M&A activity. Wait until you have gold really breaking out, and you're likely to see the miners' stock prices to also rise and follow along the way, if not lead the way to the upside, which I believe it will. But also, as the stock prices increase, their currency increase. Therefore, you're likely to see even more M&A activity, given the fact that a lot of the major companies are suffering from a lack of quality of their resources, and also a lack of growth across most of their resources as well. So those issues are likely to unfold all at once the market really starts to break out. But I caution people from waiting for that, because that is usually not the thing to do. What you want to do is to be positioned prior to those breakouts. That's where most of the billionaires in this industry made their wealth, is by positioning early and accumulating assets that are cheap, historically cheap, and then taking advantage of a secular bull market that, in my view, is inevitable given all the imbalances we have.
What do you think is going to be the final catalyst, or what are some of the things that people should be looking out for to be confirmation to them that we're really headed towards the upside in precious metals?
There's a reason why I pay close attention to the economy and the economic developments we have in developed world in particular. And I believe we're entering a recessionary period and likely a hard landing, but it's just going to play out different than 2008, in my view. As I've pointed out before, I think this is a very stagflationary economic environment, and that will probably favor hard assets while the economy actually decelerates and enters into a contraction, particularly things like gold, which have been actually served as a defensive asset in the past, and also an enhancer of quality of international reserves across most central banks. Those are basically the catalysts. Is really the economy starting to show some real weakness, and we've got a plethora of macro indicators right now suggesting that a recession's in the horizon. Yield curve was deeply inverted and now steepening, which is usually a sign of a recession on its way. We've got over 12 months already of consecutive declines or consecutive prints below 50 on the ISM manufacturing. We've got corporations been in a upward trend of a 7-year channel of earnings per share, and now at a critical juncture, likely to start seeing some contraction in fundamentals. We've had a lack of leadership in the market. If you look at most of the performance that we've had so far this year, it has come from really 7 stocks, which is very similar to what we saw back in late 90s during the tech bubble, and which was really carried by the technology sector. So the lack of leadership is also something to be aware of. And the other factor that I think it's probably the most important, that is often ignored by market participants, which has to do with the fact that the economy is quite resilient at the beginning of the monetary tightening cycle. But we've been into this for close to 21 months now in the interest rate hiking cycle, and also in the quantitative tightening, we've been close to 20 months now. So we should be, we expect to see some real weakness in the economy coming from those lagging effects in the Fed policy. And so I would really caution folks in this environment right now from risky assets that remain historically overvalued, which is also a classic late cycle indicator, is how we tend to see valuations of assets to be highly inflated at the very end of a bubble. And so to me, those are more the triggers, and the foundation of the thesis for precious metals is there. I mean, we've got production of gold declining across most of the majors, which marked the beginning of a secular market in the 70s and the early 2000s. We have central banks accumulating the metal. We have a trifecta of macro imbalances with the debt problem of the 40s, the inflation of the 70s, and the valuation problem of the late 90s. We have deficit issues that are, in my view, just worsening given interest rate payments rising now, and the need for this upward movement of spending in infrastructure and defense spending and other things. We have deglobalization signs. So all those things are adding to the case of precious metals, despite this consolidation mode that we've had, in which gold to me is poised for a major breakout, and that will mark the beginning of a cycle in my view.
You mentioned inflation, and a lot of people watching, if they're looking at the CPI, might be thinking, we're out of the woods. We're back to 3% inflation now. But you did some research on the 2 other inflation cycles we saw in the 20th century. And there were actually 3 waves. It kept getting worse each time inflation came back. And I'll put the charts here. You see really the waves of inflation we saw in the 70s, but also in the 30s and 40s. We're definitely not done with inflation if history is going to be repeating itself.
It is so important and relevant to go back and really think about all the pillars of inflations that we have currently in the system. And inflation is highly entrenched and ingrained in the economy. And I would caution folks to really be cheering on the recent CPI data and other inflation data points, although median CPI still remains at 5.5%, which is historically high, and also should be really be causing cost of capital to remain high or elevated for longer. But inflation, as you pointed out, certainly tends to develop through waves, and doesn't mean necessarily we will see exactly 3 waves like we saw in the 40s and 70s, which was precisely 3, but it could be more or less. I do think, however, it's a psychological phenomenon that tends to occur and tends to feed on itself over time. And the base effects is the main reason why you tend to see those waves really unfold. I believe we're in the process of bottoming in inflation. If you look at across most of commodity producers, we really haven't seen the increase in capex that tends to really give you conviction that inflation is out of the woods. I don't think we've really resolved a lot of the deglobalization problems that continue to intensify globally. In fact, we've got two wars unfolding right now. We haven't really seen any fixes in terms of the reckless amount of fiscal spending in the economy. That is certainly a problem. Or the issues with labor markets regarding the fact that we're seeing labor strikes almost every week across different industries and across different countries as well. So all those things are going to continue to add pressure on the long term for inflation to stay historically elevated. And what does that mean for investors is very relevant, actually, because during inflationary eras, you tend to perform very well if you buy hard assets. And hard assets today are one of the most underallocated across history that we've seen. And across 60-40 portfolios, even among central banks that now hold 20% of the balance sheet into hard assets, i.e. gold, relative to 80% of sovereign debt securities still. So there's a lot of room for change in terms of the capital dynamics that can actually lift hard asset prices over time. And so I wouldn't bet against any hard asset for the next 10 years. I think that that's the place to be. And investors that have the skill set to really understand those markets, regardless if it is metals and mining, agricultural, energy, emerging markets that have favorable conditions across resource industries, all those are likely to do very well in this next decade.
And it is interesting pulling up this chart here as well, the commodities to equity ratio that you've developed there, and how it seems like commodities are still near 50-year lows when compared to equities. And this is a bit surprising to me, given that we've already seen a lot of inflation and the stock market down last year substantially. So where do we go from here? It seems like this is just a stronger case that commodities have to rise.
Yes, a few points to emphasize. Number one, this is one of the most important charts for the next decade, in my view. And I should give credit where credit is due, where Ronnie Stefrole from Increment and AG is the person that presented that to me at first. And I redesigned the chart, but really is the credit goes to him. And I look at this chart almost on a daily basis and think about this chart almost on a daily basis, because I believe strongly that this tells you the story about the macro environment we're in. It tells you the story about how expensive financial assets are across not only equities, but really even in the fixed income market. Although we've had some repricing recently with interest rates rising, we haven't really seen that happen across most of the corporate bond markets and other instruments. And so I would say that this is also reflective of the value versus growth situation that we have and transition that we're seeing. And so to me, for investors that don't want to get too fancy, I think avoiding being in a bubble, avoiding being in its speculative side of the market is very important to survive in the next 5 to 10 years. And any markets, you always want to be avoiding highly speculative assets. And so equity markets, to me, don't present a great risk-reward opportunity for the next 5 to 10 years again. However, hard assets and commodities specifically certainly do. And there's a reason why you're seeing Brazilian equities, for instance, trading at 5 times earnings, while you see FANG stocks trading at 50 to 100 times earnings. And it's not too difficult. It's simple, in fact, to just avoid being on things that are really loved and often talked about, and actually start really getting more interested in things that are unloved and often seen as skeptical, such as the mining industry or resource-rich economies. I can't think of a time in history that we're going to see affordability of housing improving with the building of residential markets, along with defense spending, along with really revamping manufacturing plants in the US and improving highways and airports and manufacturing capabilities again, without seeing the metals and mining industry becoming a much more relevant part of the economy. Right now, it's less than actually 0.2% of the S&P 500, in which for every dollar that comes into the global equity market, only 3 cents are going to commodity producers. And so what gives? I know I much rather own this part of the market than, let's just say, technology companies or even Microsoft and Apple, which I call them the Magnificent Two, because they have a 15% weight in the S&P 500, which is 70 times higher than the metals and mining industry. We've never seen this level of dominance in equity markets. And I don't think this is really going to be paying out well for investors over the long term. I think something has to give, and we have to go back to the real necessities that we have to run the global economy. And I think metals and mining will be one key place to be an investor of over this the next years. And so I'm really focused on that part of the market right now.
You mentioned the small percentage that investors are actually investing in metals and mining and resource companies. I did want to ask you, as we see, this move, I guess, into commodities or this revaluation of commodities, how will that change the 60-40 portfolio? Because you recently wrote an article, and I'd recommend people definitely check out crescat.net, where they can find all the articles that you've been writing, and you analyze, this has to change. You mentioned how there has to be this redefining of the traditional portfolio. Your take?
Yes, we've looked into the history of the yield provided by 60-40 portfolios, and our conclusion was that this type of allocation has never been more expensive, but those tend to actually be very secular changes in those the performance or the likelihood of those portfolios to do very well. Usually, that's why it's so important to understand the inflation picture, and why is because usually the best investments during those periods are the ones that have pricing power. And pricing power sounds simpler than what it is. It's actually highly complex to find companies in the traditional markets that have those capabilities of increasing prices relative to their cost. Every company in the world today is facing rising costs operationally or materially, and those issues are likely to persist over time. So commodity companies, despite the fact that you also see operational costs rising, they actually tend to have a very high pricing power, aspect relative to other industries. Therefore, why you tend to see natural resource companies do so well, along with emerging markets that have a lot of natural resources doing very well relative to other industries and other developed economies. I think this is going to play out very similarly to those other decades. And I would say that the main reason for that is because hard assets tend to rise, and that creates an inherent margin adjustment in most of those business models. And so I don't think this time is going to be any different. And a lot of people are focused on the fact that we've had a rise in cost of most of commodity producers, but wait until hard assets really start catching up to the upside, because supply issues have been very constrained given the fact that they're not really spending a lot of capital. And this is, again, quite usual, quite typical of this part of the market, where you go from excessive spending and misallocation of capital to now extreme conservatism and then lack of access for capital. This is precisely where we are currently. That tends to actually lead to a long-term cycle and opportunity in most of those natural resource producers. And so to me, this is this is why I think the focus for most investors needs to be shifted away from technology and software and even AI, but towards things that are more boring, but actually offer great value, and historically have never looked so cheap and more attractive and more compelling from a macro and value perspective.
I know a lot of analysts out there are looking at a recession coming in the near future and are actually not as bullish on industrial metals and more looking at gold and monetary metals. And there's obviously a metal, silver, that's kind of plays both worlds there. So your perspective on that, why are you also bullish on industrial metals right now, and your take on where silver is headed in the near future?
Because none of us can really time the market perfectly. And I would say that what is important here is how cheap those markets really are. I mean, silver, yes, can get caught up in recessions, although I really think it's important to go back during the 73, 74 stagflationary crisis, where hard assets, oil, silver, copper, all those that are very cyclical actually were rising while the equity markets and fixed income markets were falling. And so could that happen again? Yes. In fact, metals and mining industries during those periods actually appreciated while the markets were falling. And the main reason for that is because hard assets become a safe haven during those periods, not just gold, but others too. And that's because we're in an inflationary era where inflation is just running hotter than usual. It doesn't matter. It's been decelerating over the last months. Just the fact that it's been running hotter than usual forces a lot of things and a lot of dynamics and correlations to change. I can give you many examples. One of them would be the Japanese yen, which used to be a classic defensive asset that has been collapsing, or TIPS, or the Treasury inflation protected securities that are now falling apart as well, or just the fixed income market in general as well. So if you're a portfolio holding those assets, you're starting to rethink how you position yourself. And more, I believe those folks that are running those large pools of capital will start thinking about those correlations that happen during inflationary eras, and therefore why I believe hard assets will attract a lot of that capital over time. And so there's a reason why they tend to do well during stagflationary eras. I would not ignore those periods, because a lot of people are looking back in 08 and 2020 crash and even the early 2000s. And those are probably not the analogs we should be given a higher weight to. We should be prioritizing periods that resemble what we're seeing currently, which are much more of a stagflationary era, despite, regardless if it is the 40s or the 1970s, 40s more because of the leverage problem, and 70s more because of the type of inflation really being driven by a lot of it has to do with the fact of the labor markets and the reckless amount of fiscal spending too. So those issues are today is unique. I won't go outside of here to not say it's unique. It's quite unique. But the market behavior that happened during those periods are not unique. They're actually, we tend to see those movements towards hard assets for a reason. And I think this is going to happen once again. So I wouldn't ignore those periods at all. And I would use them as a model. The three waves of inflation, the fact that labor markets tend to lag, all those things are very relevant to navigate this environment right now.
Now, I know a lot of analysts have been looking at how central banks have been accumulating gold, different countries around the world buying more and more gold. I know you recently reported that actually for silver, India had its biggest, they imported the most amount of silver they ever had in 1 month. Your perspective on the significance of this?
It's incredibly significant, because we know India as a culture has, again, deeply ingrained that households tend to hoard hard assets, particularly gold, in any periods of their history. And so when you see that rising significantly, I would definitely be paying very close attention to. Somebody pointed out the fact that what's happening right now is quite unique, and actually it has got a lot of seasonality effect because of the wedding periods in those during in that country and so forth. But there's no seasonality effects actually shown in this chart. In fact, I would point out the fact that GDP in India has been basically stagnant, and I would say that the equity markets there has also been very stagnant over the last 2 years. And so there's not much of a specific reason outside of investors really being, or households hoarding silver and other precious metals. And so I believe that that's just kind of strengthening the case for the metal overall. And, keep in mind, I mean, we're at a gold to silver ratio of about 83 currently, which is historically high. If I do believe that we are in a precious metal cycle, or at least in the early stages of that. If we do get into one, and I end up being right about this, silver is likely to lead the way to the upside, and can certainly see an explosive move to the upside as well. And so I wouldn't bet against the metal, and I continue to think that it's the cheapest metal on earth, and therefore why I also pay close attention to it and continue to accumulate assets that have exposure to silver.
All right. Well, Tavi, we really appreciate your time today. If our viewers are interested in learning more, they can go to crescat.net. Did you want to share with the viewers any last thoughts you had and remind our viewers of your work there?
No, I appreciate the time again, and I would be very cautious one more time with other parts of the market that carry unnecessary risk in this environment, with cost of capital just staying historically high relative to especially the prior decade. And you may say that interest rates being where they are just back to historical average, and that is correct. However, we have not yet seen this, especially reissuance of debt, given the fact that a lot of the debt commitments from corporations and sovereign institutions are likely to be or will be due in the next 12 months in a very significant amount. So all that debt is going to have to be reissued at much higher effective interest rates. And as we see that turning, I believe that the monetary tightening policies are going to start really working into the system and starting to cause some damage in economic development. So be very cautious about some markets that are frothy and don't really justify those valuations that they have currently. So that's my last message.
Fantastic. Tavi, thank you so much for your time today, and God bless.
Thanks for having me.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.